Like every day we focus on another different comment, different headline on inflation. Today it seems like it's more focused on the hawks. How do you make sense of it right now?
Well, the Fed did surprise the markets last week. It was definitely a shock to go from not even thinking about raising rates to having the dot plots come out with two hikes. I think the one thing that markets really need to understand is two hikes were actually already priced in before the end of 2023, before the Fed meeting last week. What happened after the Fed meeting was double the hikes got priced in. So now almost 4 hikes are priced in before the end of 2023. If I look here on my Bloomberg terminal, I can actually see the number of hikes. So in 2021, there's 6.7 basis points of like a partial hike priced in. And in 2022, there's over 1 hike already priced in. It's currently 32 basis points in 2022. And then going out to 2023, it's 2+ hikes, almost 60 basis points being priced in additionally. So I think the thing to keep in mind is, yes, the rhetoric is saying, hey, we might be hiking as early as 2022, but it's already priced into market expectations. So the Fed is saying nothing new. They're just saying what the market already knew.
So what we saw with the recent FOMC hawkish surprise was that people were unwinding these really popular trades, like when it came to the dollar, these inflation hedges like commodities. You manage the inflation hedge ETF. Do you see that a further unwinding of these inflation hedges, or are we going to be stabilizing pretty soon?
I mean, it's really bizarre. It reminds me a lot of Brexit, because the Fed basically went from saying inflation is transitory to saying, hey, we just are having inflation. And then all inflation assets got taken out back and beaten with the stick. Gold was down huge. The yield curve had the largest flattening since the global financial crisis in the 2-year 2s10s forward. It was the biggest move since November 2008. So I saw it as a huge opportunity and bought more for our fund. It was a great time to be buying low and selling high.
Okay, Nancy, you talked about that curve flattening. Has the sell-off at the front end, the buying at the long end, been overdone, do you think?
I think so. I mean, I think there are a lot of macro tourists that hear that the Fed was hawkish, and then they just go out and buy bond puts without realizing that they pushed it up from over 2 hikes to almost 4 hikes before the end of 2023. And then other investors were buying duration, probably because they think the hawkish Fed is going to put, make the economy stumble and equities will sell off. So it was kind of hit on both sides, where we had front-end yields going higher, but then back-end yields going down because a lot of people were buying duration.
If there's an expectation of volatility in the months ahead, how do you play that?
Well, it's best to just own it. That's what our eyeball ETF does, is we actually buy options. And whenever you buy an option, you are long volatility in the underlying asset class. So people think of equity volatility as the only volatility, but anything with an options market also has a vol market. It's kind of like, volatility is an input into options pricing. So IVOL is long fixed income volatility, specifically interest rate volatility. And we think it's one of the most compelling asset classes out there, because there are not many things you can buy in the fixed income market that are trading below their 3-year, 5-year, 10-year averages. Interest rate volatility is very, very cheap, in my opinion.